If you earn a six-figure income, pay your taxes on time, and put 10% of your paycheck into a standard 401k, you are doing everything the financial system taught you to do. You are told that if you remain disciplined for 35 years, compounding interest will guarantee your freedom. But there is a silent mathematical glitch built into the foundation of middle-class wealth creation. A glitch that ensures the game is rigged before you even place your first trade. Every year, millions of hard-working professionals follow the exact same playbook. They work longer hours, chase modest salary raises, and hand their savings over to institutional fund managers. Yet, despite earning more money than 90% of the global population, they find themselves trapped on an invisible financial treadmill. They are cash poor, heavily taxed, and entirely dependent on a volatile stock market to determine their future standard of living. To understand why this happens, we must look at two individuals operating under the exact same economic conditions. Meet Julian, a senior corporate manager earning $215,000 a year. Julian is the model employee. He contributes 15% of his gross salary into a 401k target date fund and holds $60,000 in a bank savings account. Julian believes his financial future is secure because he plays strictly by the established rules. Now consider Marcus, a quiet business operator who controls a private logistics company making a similar net revenue. Marcus does not participate in a traditional 401k. He does not hold large cash balances in retail bank accounts, and he does not buy off-the-shelf target date mutual funds. Instead, Marcus operates inside a completely different financial architecture, an architecture designed to capture cash flow, minimize tax drag, and convert expenses into depreciable assets. While Julian works 80 hours a week to earn a taxable W-2 income, Marcus structures his cash flow through legal entities, specialized asset structures, and tax-efficient reinvestment loops. When tax season arrives, Julian surrenders over 34% of his income to state and federal treasuries. Marcus, using the exact same tax code, pays an effective tax rate of less than 12%, legally rerouting hundreds of thousands of dollars back into his own capital pool. The divergence between Julian and Marcus is not a result of luck, intelligence, or market timing. It is the direct consequence of a fundamental system design, a design where the middle class is trained to accumulate paper assets, while the wealthy accumulate income-producing control structures. Let us dissect the first major trap hiding inside the traditional middle-class wealth strategy, the illusion of 401k compounding. For over 40 years, employees have been told that the key to retirement security is setting aside a percentage of every paycheck into a 401k or individual retirement account. The concept sounds simple. You invest in a diversified bucket of stocks, tax-deferred, and let the historical 8% annual market growth do the heavy lifting over several decades. What the brochure never explains is the hidden math of institutional expense ratios and administrative fees. When Julian selects a standard target date retirement fund inside his corporate plan, he pays what appears to be a microscopic annual fee, perhaps 1% or 1.25%, combining management fees, administrative expenses, and underlying fund costs. 1% sounds harmless. If your portfolio grows at 8%, losing 1% seems like a minor price for professional management. However, linear subtraction creates a dangerous illusion. Fees are not deducted linearly from your annual returns. They are extracted perpetually from your entire compounding asset base, regardless of whether the market goes up or down. Over a 35-year career, a seemingly small 1% fee does not take 1% of your final wealth. Mathematically, it extracts between 25 and 35% of your total potential nest egg. Consider the raw arithmetic. If Julian invests $10,000 a year for 35 years at 8% growth, his portfolio would reach roughly $1,720,000 with zero fees. But with a modest 1% fee drag, reducing his net return to 7%, his final account balance shrinks to $1,380,000. That tiny 1% fee swallowed over $340,000 of Julian's hard-earned wealth. Money that went directly to Wall Street fund managers without Julian ever receiving an invoice. This fee extraction mechanism operates in complete silence because it is deducted directly from the fund's net asset value before Julian ever sees his quarterly statement. Julian sees a green balance number increasing over time and assumes his strategy is working perfectly. unaware that a third of his lifetime compounding engine was quietly harvested by the institution managing his capital. Yet, fee drag is only the first layer of the middle-class trap. The second, more dangerous mechanism is the deferral trap built into traditional qualified accounts. Julian believes that contributing pre-tax dollars into his 401k is a brilliant tax move because it reduces his current taxable income today. But in reality, Julian is entering into an asymmetric contract with the government, a contract where the terms are entirely unwritten and subject to change. When you contribute pre-tax dollars to a 401k, you are agreeing to defer tax on the small seed today, in exchange for paying full income tax on the entire grown harvest tomorrow. You are postponing your tax liability to a future date, a date when you will have zero control over what the federal tax rates will actually be. Look at the systemic trajectory of national balance sheets. With the federal debt surging past $34 trillion and mandatory entitlement spending accelerating, structural tax rates for middle and high earners decades from now are mathematically almost guaranteed to be higher, not lower. Julian is postponing taxes during an era of historically low income tax brackets, only to pay taxes during a future era of massive debt monetization and elevated tax rates. Furthermore, when Julian eventually begins withdrawing money from his 401k in retirement, those distributions are taxed as ordinary income, the highest taxed income category in the code. While investors like Marcus pay long-term capital gains rates or utilize zero-tax debt liquidity strategies, Julian pays top-tier ordinary income rates on every single dollar he spent 35 years accumulating. The system incentivizes Julian to lock his liquid wealth inside a qualified plan where he cannot touch it without facing severe 10% penalties before age 59 and a half. For 4 decades, his money is effectively held hostage, trapped inside financial assets that he cannot use to take advantage of real estate downturns, business acquisitions, or strategic market opportunities. While Julian's capital sits locked inside paper vehicles, he faces an even more aggressive predator operating in the background, the silent erosion of real purchasing power. The middle class is taught to measure wealth in nominal dollars. Julian looks at his bank app, sees $60,000 in his high-yield savings account, and feels a false sense of security. He sees an interest rate of 4% and believes his cash is working for him. What Julian fails to realize is that the official consumer price index is a heavily curated government metric that excludes the true cost of asset expansion. To understand how purchasing power actually disappears, you must track the expansion of the M2 money supply, the total measure of all currency circulating throughout the economy. When central banks and financial institutions expand the broader money supply by 7 to 10% annually, the real baseline cost of scarce assets like land, housing, healthcare, and high-quality equities rises at that exact same pace. If M2 currency expansion averages 8% a year, and Julian earns 4% interest in a commercial bank account, his actual purchasing power is shrinking by 4% annually. Over a decade, that $60,000 cash reserve loses more than 30% of its real ability to purchase tangible physical assets. Julian is running on a financial hamster wheel, saving depreciating currency while the real cost of living pulls further out of reach. This monetary debasement also distorts Julian's stock portfolio gains inside his 401k. When the broad equity market rises 8% in a given year, much of that rise is not driven by increased corporate productivity or higher economic efficiency. It is driven by currency debasement, an excess of newly created dollars chasing a fixed supply of corporate shares. Julian celebrates an 8% paper gain, unaware that after accounting for real price inflation, tax liabilities, and fund fees, his net real return is virtually zero. Marcus approaches monetary expansion from the opposite side of the balance sheet. While Julian saves depreciating dollars, Marcus positions himself inside hard physical assets that automatically reprice with currency debasement. When the money supply expands by 8%, the replacement cost of Marcus's industrial equipment, commercial real estate holdings, and logistics infrastructure increases accordingly. Instead of being victimized by inflation, Marcus uses it as a financial tailwind that increases his asset values while melting away the real burden of his fixed-rate business debt. This leads directly into the second major structural divider between Julian and Marcus, the strategic use of leverage. The financial system trains the middle class to view debt through a purely consumer lens. Julian was taught that debt is either a tool to finance a consumer lifestyle or a dangerous trap to be avoided entirely. As his corporate salary grew to $215,000, Julian accumulated standard consumer liabilities, an $80,000 luxury sedan financed over 72 months, high-interest consumer credit cards used for rewards points, and personal loans for home renovations. Every one of Julian's debt obligations is tied to a depreciating liability. The $80,000 sedan loses 20% of its value the moment it leaves the dealership lot, yet Julian pays 6% interest on the entire original principal. He is paying interest on an asset that is rapidly shrinking towards zero. To make matters worse, Julian pays for these loan installments using post-tax income, meaning he must earn nearly $120,000 of gross W-2 income just to pay off $70,000 or $80,000 of consumer debt and interest. Marcus, on the other hand, utilizes asset-backed debt structures that are fully integrated into his business entities. When Marcus borrows $2 million to acquire commercial logistics equipment or warehouse facilities, the debt is secured entirely by the revenue-producing assets themselves. Marcus never pays down debt with personal W-2 income. Instead, the operational cash flows generated by the equipment pay off the principal and interest automatically. Furthermore, the tax code rewards Marcus for holding this debt. Under current tax provisions, Marcus can apply accelerated depreciation and cost segregation studies against his physical assets, generating massive paper losses that offset his operational income. While Julian pays 34% in personal taxes while servicing consumer debt, Marcus uses tax-deductible business leverage to generate positive cash flow while reducing his taxable income to near zero. The middle-class consumer trap extends directly into residential housing mechanics. Like millions of high-earning professionals, Julian purchased a $600,000 primary residence, putting 20% down and taking out a $480,000 30-year fixed-rate mortgage. Julian was told by real estate agents and personal finance books that buying a house is the greatest wealth builder available to the middle class. What Julian did not examine was the brutal front-loaded structure of bank amortization schedules. On a standard 30-year fixed mortgage, the interest payments are heavily weighted toward the beginning of the loan term. In the first 10 years of Julian's mortgage, over 65% of every single dollar he pays to the mortgage servicer goes strictly toward bank interest, not reducing his loan balance. During those initial 10 years, Julian pays hundreds of thousands of dollars in interest, property taxes, home insurance, and maintenance costs, while his actual principal balance barely trickles down. If Julian decides to sell or move after 7 or 8 years, a common timeline for modern corporate executives, he realizes that he accumulated almost zero real principal equity from his monthly mortgage payments. The primary beneficiary of his home ownership was the lending institution that captured 7 years of front-loaded interest yield. Marcus views primary residential real estate through a completely different financial lens. He recognizes that a personal residence is an illiquid consumption asset that drains monthly cash flow through undeductible property taxes, interest, and upkeep. Marcus controls his living arrangements through corporate entities or strategic lease agreements, ensuring that his primary housing costs do not tie up liquid capital that could otherwise be deployed into cash-flowing income vehicles. By shifting capital away from locked personal home equity, Marcus retains liquid reserves that allow him to execute during market dislocations. While Julian's net worth is tied up in an illiquid residence and a restricted 401k, Marcus maintains immediate access to flexible credit facilities. These flexible credit facilities allow Marcus to bypass the traditional tax obstacles that systematically restrict middle-class capital accumulation. To comprehend why the middle class remains trapped while business owners accumulate compounding wealth, one must understand the fundamental architecture of the Internal Revenue Code. Most working professionals believe the tax code exists solely to extract revenue for the federal government. In reality, the tax code is an incentive system designed to reward specific economic behaviors. The government uses tax incentives to encourage private citizens to build housing, fund energy production, employ workers, and invest in capital infrastructure. If you perform those favored economic activities, the tax code rewards you with deductions, write-offs, and credits. If you do not, if you simply sell your labor for a paycheck, the tax code penalizes you with the highest rate brackets in existence. This is the W-2 trap that grips Julian. Because Julian earns $215,000 as a corporate employee, his income is taxed at the source before he ever sees a single dollar in his bank account. His employer automatically withholds state, federal, Medicare, and Social Security taxes. Julian receives what remains, post-tax dollars, and must cover his mortgage, car loan, living expenses, and 401k contributions using that diminished net income. The order of operations for a W-2 earner is catastrophic for compounding. Julian operates on the formula: earn income, pay top-tier taxes immediately, and spend what remains. Because taxes are extracted up front at 34%, Julian loses over $73,000 of capital every single year before he can even attempt to save or invest. Marcus operates on an inverted financial formula: earn income, spend and reinvest through business structures, and pay tax only on the tiny net remainder at the bottom. Through his logistics entity, Marcus captures gross revenue before a single tax dollar is withheld. He then deploys that revenue into tax-deductible operational expenditures, paying key personnel, acquiring depreciable fleet assets, purchasing office facilities, and funding software infrastructure. Every dollar Marcus spends on business expansion is spent using pre-tax capital. While Julian must earn $150 of gross W-2 income just to spend $100 on a personal work asset, Marcus spends $100 directly through his operating company, deducting it against gross income and reducing his tax liability simultaneously. Furthermore, Marcus utilizes specialized provisions within the tax framework to convert personal lifestyle expenses into legitimate business deductions. Under Section 105, Marcus's operating company establishes a formal medical reimbursement plan, making all out-of-pocket medical, dental, and health expenses fully tax-deductible business costs. Under Section 179, Marcus writes off the entire purchase price of heavy business vehicles during the very first year of service. Using the 14-day rule, often known as the Augusta Rule, Marcus's operating entity rents his personal residence for formal corporate board meetings for 14 days each year. The operating entity writes off the market rate rental fee as a deductible business expense, while Marcus receives those rental payments into his personal bank account, completely tax-free under Section 280A. Through these legal tax mechanisms, Marcus systematically converts personal cash flow drains into corporate tax write-offs. By the time Marcus calculates his net taxable income at the end of the year, his paper revenue has been offset by depreciation, operational deductions, and legal write-offs, bringing his effective tax rate down to less than 12%. The second major mechanism separating Julian and Marcus is the concept of money velocity. The financial industry conditions the middle class to accept a static, slow-velocity capital strategy. Julian's money moves in a single direction, from his paycheck into a 401k target date fund, where it remains parked and immobile for 35 years. Julian's dollar performs exactly one task during its entire lifespan, sitting inside a basket of public equities, exposed to fee drag and market volatility. Marcus operates on high-velocity capital principles, the science of making a single dollar perform multiple financial tasks simultaneously. When Marcus generates a dollar of profit inside his business, he does not park it in a static lockbox. Instead, he routes that dollar into an income-producing physical asset, such as a commercial storage warehouse or automated distribution center. That single dollar first generates an immediate tax deduction through cost segregation and accelerated depreciation. Second, the commercial warehouse produces monthly rental cash flow. Third, Marcus uses that physical asset as collateral to secure a tax-free bank credit line, borrowing back 80% of his original capital without selling the property or triggering a taxable capital gains event. Marcus then takes that borrowed cash line capital, which carries zero tax liability because debt is not considered income by the Internal Revenue Service, and deploys it into his next business expansion or real estate acquisition. A single dollar inside Marcus's system created a tax deduction, generated monthly cash flow, provided borrowing collateral, and funded a secondary asset acquisition. Marcus accelerated the velocity of his money, while Julian's dollar sat stagnant inside a 401k target date fund. This velocity model reliance on asset-backed borrowing reveals why wealthy individuals rarely sell their primary assets. The middle class is taught to buy assets, wait for appreciation, sell them, pay 20 to 30% in federal and state capital gains taxes, and live off the remaining cash. Wealthy operators view selling assets as a structural failure. When Marcus accumulates millions of dollars in appreciated equity across his real estate and business holdings, he never liquidates those positions to fund his lifestyle. Liquidating would trigger massive capital gains taxes and destroy his compounding base. Instead, Marcus approaches institutional private banks to establish securities-backed lines of credit or asset-backed portfolio loans at low institutional interest rates. Because loan proceeds are legally classified as debt rather than income, Marcus receives millions of dollars in liquid capital with zero income tax liability. He uses these private banking credit lines to fund his personal living expenses, acquire new income-producing assets, and expand his business holdings. The interest on the loan is often tax-deductible if deployed for business investments, creating yet another layer of efficiency. While Julian pays ordinary income taxes on every dollar he withdraws from his 401k in retirement, Marcus lives off tax-free debt streams backed by appreciated asset pools. When Marcus eventually passes away, his assets receive a step-up in tax basis, wiping out decades of unrealized capital gains taxes for his heirs, completing a perpetual cycle of wealth creation that completely bypasses the middle-class tax trap. This generational transfer mechanism highlights the psychological engineering that keeps high W-2 earners anchored to the middle-class playbook. The corporate economic environment is structured to encourage lifestyle inflation. As Julian moved up the corporate ladder from junior manager to senior executive, his salary increased from $75,000 to $215,000 a year. However, with every promotion and salary increase, Julian expanded his personal burn rate. He upgraded to a larger home with higher property taxes, leased luxury vehicles every 3 years, and absorbed expensive private social obligations. The corporate system relies on this psychological lock-in. By tying an executive's social status to high monthly overhead, it ensures that high earners remain dependent on their next paycheck, unable to risk leaving the corporate treadmill to build independent capital structures. Julian fell into the classic high-income trap, earning more money while becoming structurally less financially secure. Because his personal overhead rose in direct proportion to his gross income, his liquid savings rate remained static at less than 10%. Julian was trapped in a golden cage, mistaking a high standard of living for genuine financial strength. Marcus practiced strict capital insulation. When his business profits scaled, Marcus did not expand his personal consumer footprint. Instead of acquiring personal liabilities to display status, Marcus directed corporate profits into an entity treasury account. He drew a modest salary from his operating company, maintaining a lean personal profile while expanding the balance sheet of his holding companies. Marcus understood a fundamental truth of quiet wealth. Status assets consume capital, while invisible control structures compound capital. Marcus established a dual entity structure, separating his operating logistics company from a parent holding company that held the underlying equipment leases and physical real estate. By insulating his personal identity from his net worth and placing operational risk behind corporate asset shields, Marcus avoided the lifestyle inflation trap that drains 90% of high earners. To see the full structural consequence of these two opposing methodologies, we must fast forward 35 years to the day both Julian and Marcus reach age 65. Julian arrives at age 65 having done everything asked of him. He contributed faithfully to his corporate 401k target date fund for over 3 decades. On paper, Julian's investment dashboard displays a balance of $1,400,000. To the untrained eye, Julian is a millionaire who successfully achieved the American dream. However, when Julian attempts to convert that paper figure into retirement cash flow, the structural flaws of his strategy become devastatingly apparent. Under mandatory distribution rules, Julian must begin withdrawing funds from his account. Because every single dollar inside his traditional 401k was deferred pre-tax, every withdrawal is taxed as ordinary income at top-tier rates. When state taxes, federal taxes, and Medicare surcharges are extracted, Julian's 30% tax burden strips away $420,000 of his paper balance immediately. Furthermore, after accounting for 35 years of cumulative currency debasement, his remaining net capital has less than 40% of the purchasing power it held when he began his career. Julian discovers that his $1,400,000 nest egg yields less than $55,000 a year in real, inflation-adjusted, post-tax spendable income. Julian is forced to downsize his lifestyle, live on a fixed budget, and continuously worry that market downturns or medical expenses will exhaust his savings before he dies. He spent 35 years working 80 hours a week, only to land in financial fragility. At age 65, Marcus operates in a completely different financial universe. Marcus controls an asset portfolio valued at $15 million, comprised of cash-flowing commercial real estate, triple-net industrial flex warehouses, and private credit notes held within an irrevocable dynasty trust framework. Marcus's asset portfolio generates over $600,000 in annual net rental cash flow. Because his properties are sheltered by continuous depreciation, cost segregation studies, and entity deductions, Marcus pays an effective tax rate of less than 8% on that cash flow. When Marcus requires additional liquidity for large purchases, he does not liquidate assets or pay capital gains taxes. He accesses low-interest private bank lines of credit secured by his commercial real estate portfolio, drawing millions in tax-free debt proceeds. When Marcus eventually passes away, his dynasty trust transfers $15 million in physical assets to his children with a stepped-up tax basis, completely wiping out decades of capital gains taxes and securing multi-generational financial immunity. The contrast between Julian and Marcus demonstrates that middle-class struggles are not caused by a lack of hard work or personal discipline. Julian worked just as hard as Marcus. Julian paid his taxes, saved his income, and followed every piece of advice given to him by conventional financial institutions. Julian lost because he played a game where the rules were written by institutions designed to harvest his capital through fees, taxes, and inflation. Breaking out of Julian's path does not require millions of dollars in startup capital. It requires an immediate shift in financial engineering. The first step is abandoning the illusion that a high W-2 salary and a passive 401k target date fund will guarantee financial freedom. You must transition from a pure labor supplier to an owner of control structures. Step 1 is establishing a legitimate operating or side entity, such as an LLC or S corporation, to begin capturing gross revenue and accessing pre-tax expense deductions under the tax code. Step 2 is shifting your capital focus from passive paper asset accumulation to cash-flowing physical assets that benefit from currency debasement and accelerated depreciation. Step 3 is replacing consumer debt with asset-backed leverage, ensuring that every dollar borrowed is serviced by operational cash flows rather than your personal paycheck. The rules of the financial system are publicly available, written directly into corporate law, trust codes, and tax statutes. The financial system will continue to harvest those who blindly follow consumer advice, while quietly rewarding those who build control structures, capture cash flow, and master the mechanics of quiet wealth. When you stop operating as a retail consumer inside a financial system designed for labor and begin operating as an institutional manager of your own capital, the entire matrix flips in your favor. True wealth is never built in the public spotlight. It is built quietly, systematically, and permanently behind the scenes.